Good day. Dan Davis, ADK Wealth Advisory Group, President and Co-Founder, and Financial Planning World Co-Founder. Coming to you from our St. Louis office, wrapping up 2023, another year in the books. 35 of them, kind of hard to imagine. But in any case, if I were going to really talk about 2023 from a financial market standpoint, I'd say number one, we, at the beginning of the year, said that we thought that the stock markets would be fully recovered by sort of end, today, or end of Q1 of 2024, and most of the markets are fully recovered. A lot of them have hit all-time highs. So that part's happened. In our last video, I retracted and pushed that off a little bit because Hamas had attacked Israel. Markets had pulled back pretty steep. But since then, the Fed stepped in and basically said they feel like the inflation targets have been met and that they won't need to raise rates anymore. And they released their dot plot, and the result of that was the stock market started running up, believing that the Fed will actually start cutting rates next year. So bond market, we had said that it would take 3 to 5 years to recover. I think that's pretty accurate. I think I'm in the camp that would say we've got 2 to 3 years left before the bond market's fully recovered from what happened in 2022. 2023 was a good year for the bond market. Neither of those things felt like they were good years because they were so choppy. And when you turn the television on or open the newspaper, there's just so much geopolitical and political crazy that it's hard to really feel good. So the sentiment's negative, but the results have been positive. If I were going to say the things that surprised me most, as you know, in January of 23, we started some semiconductor positions. Those we expected to do well. They've done significantly better than we anticipated. That's a good surprise. A bad surprise is our lithium investments. With all the stuff going on with electric vehicles globally, I would have thought that would have done better, but the price of lithium has continued to plummet, and as a result, everything that's correlated with lithium manufacturing, batteries, blah, 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 is all just done pathetic. Our view is over the next 3 to 5 years, that might be one of the best performing assets in the portfolio, but next year being an election year, you just don't know who wins, and if the Republicans were to win, there's a really good chance that the push towards petroleum and coal would hurt lithium, but lithium might be so low that it bounces up. So we're watching that really, really closely. The other big surprise for me is that inflation actually hit some of the targets that people were talking about. I thought it would be harder to tamp inflation down, but the Fed responded pretty vigorously, and it appears as though it's worked. Some random thoughts that are related but somewhat disconnected is, one, if you take a look at any index like the S&P 500 that has about half growth and half value, and you just look at the raw returns of growth and value, you basically could say that growth did more than double what value did. That's a surprise for me. I did expect growth to outperform, but not at that level. If you do mega cap, large cap, mid cap, small cap, the mega caps really did the best. Large cap right behind it, and in some cases those did like twice the return that small did. We don't have any small in the model because we expected large to outperform, but again, not by that level. Another thing is when you break the S&P 500 up into its subsectors, the only subsector that had negative returns was utilities. You had some that just eked out a little bit of a positive return, like consumer staples, energy, healthcare. And again, you had things that hold the really large AI companies that really did well, like 50+% rate of return. So some of the key drivers for 2023 that I think will continue into 24, really Fed geopolitics. So let's do Fed first. First half of the year, the Fed was still fighting inflation and tightening, and hawkish verbiage was a true headwind and hurt the stock market and the bond market. The second half of the year was the exact opposite of that. They're announcing of the fact that they had inflation apparently under control, that the pause was continuing, and they released their dot plot that illustrated that they probably would lower rates 2 or 3 times next year. That really excited the stock market and the bond market to the point where, the last 3 months, October, November, December, have been very robust for both. And I think that trend continues in the first half of next year and probably the entire year. Geopolitics is what I would classify as really as the wild card. I mean, who really knows what's going to happen in the Middle East when you think about Hamas, Israel? Is there a ceasefire soon? Does it escalate and Iran gets directly involved, not just through proxies? What happens in Russia with Ukraine? There's so much that is unknown. But the most likely scenario is that those things have already had the worst and that they're tapering down. Most likely scenario, but it's very unpredictable. If you really oversimplify it, after the Soviet Union fell apart, we had one global superpower, the United States. And you now have this vying for power globally where that is no longer the case. And you've got China, Russia, all of this upheaval of battling for who's going to have real global power. I don't think there's any one winner when it comes to all of that. There's definitely what I would classify as a crisis season that we're in. If you like to read stuff on social economics, there's a book called The Fourth Turning. It's actually been updated recently, and I've just started The Fourth Turning is here. And the theory behind it is that you go through these secular 100-year periods of time with these 4 subcycles, and the fourth is called The Fourth Turning, and it's crisis. And they last for like 20, 25 years. And I think the crisis season that we're in started around 2008. If it goes for 20 years, we've got, call it, 4 more years left of it. If it goes for 25, we've got 9. So I don't think that this crisis season is like a short little window. I think it's truly an extended period of time. Why I bring that up is that you can have really good returns, but in a crisis season, the sentiment's so bad it just doesn't feel good. And I think that trend continues, not just into next year, but beyond. So our expectations, first half of next year is the stock market, bond market, that we get respectable returns. The second half of the year, the election risk comes in, creates a lot of choppiness. Does that start in May, June, July? Who knows? But until the election's decided, I think the most likely scenario is you just got a lot of volatility and choppiness. I think the Fed next year does start to loosen. Where loosening being lowering rates, and the stock market, the bond market continue on the path that they've been on the last, I'll call it the last 6 months, which has a lot of choppiness but positive returns. And then that just gets down to volatility. Volatility is here to stay, and so are we. We're here to stay in your corner, helping you out. I want to thank you, wish you a happy 2024. May it be profitable for all of us, and also have much health and joy. Thank you for your trust, your relationship. I mean, I was just talking with someone today. They referred their son to us, and I was chatting to their son on the phone as we're getting ready to start working with him and his wife. And he said, "Yeah, I know you've been working with my mom and dad for like 30 years," and it's hard to imagine. But may it be another 15 to 20 for me, and that the team continues well beyond that, serving your family. And so, signing off from the St. Louis office. Today is the last trading day of 2023, and appreciate your time.